What's something every great investor uses to help manage their money? It's a clear investing strategy. And in this video, we're going to talk about what you need to know to help start building yours. Let's start off with why even build a strategy in the first place? It's simple. You want to get to where you're going. A strategy is kind of like having a roadmap. You don't drive somewhere you've never been without knowing how to get there. Investing is no different. It's designed to help you reach your financial goals, like retirement, buying a home, or something else. Your investment choices represent different routes along the way that help you get to your goal, all with varying risks and returns. The market, like traffic, can be unpredictable, but a good roadmap helps you keep moving towards your goals. Now imagine you didn't have a strategy. Sometimes it might work out, other times it might not. Year after year, choice after choice, you could get set off course. Emotions can get the best of us when we invest, but a strategy helps you avoid that so you can make decisions based on where you want to go, not how you feel. If there's one fact I want you to know, it's this. Investors who have a clear strategy and stick to it tend to outperform those who don't. That's the why. So let's talk about the how. Experts say, consider covering all your minimum payments, have enough cash in the bank to cover day-to-day expenses, take advantage of your workplace 401k match if you have one, pay off high-interest debt, and fully fund your emergency savings. Once that's out of the way, ask yourself some questions so you can nail down the reasons you're investing. Are you investing for something long-term, like retirement? Something more short-term, like an upcoming degree? Or something in between, like a house? What's the timeline for that goal? Or do you not know? Is there a chance you might need that cash before then unexpectedly? These answers will help you build the strategy that makes the most sense for your goals, how long you're looking to invest, and how much risk you're comfortable with. Speaking of risk, figuring out how much you're willing to take on is one of the most important parts of your strategy. Risk is a two-way street. The more you're willing to accept, the greater your potential for both gains and losses. If your goal is coming up soon, you might want to take less risk since a down market could set you back without much time to recover from it. On the flip side, if your goal is decades out, you might feel more comfortable with more risk. That's because you potentially have more time to recover from a down market. But it's not all about your timeline. You want to think about your financial situation too. If there's a chance you might need that cash for something else, then that may reduce the amount of risk you're comfortable taking on. That leads me to the next step. Picking your investments. Stephanie, an investment professional at Fidelity, is going to help us understand where to start.
Thanks, Nia. Let's go over some common investment types and what to look out for. First, stocks. When researching a stock, look at the company's business potential and ability to grow market share. Also, its revenue and earnings growth, the value of its products or services, and how the stock is rated by trusted analysts. Second, bonds, which are a type of loan you give to companies, the government, or another entity. When evaluating a bond, start by checking its credit rating. That gives you a sense of the issuer's financial health and how likely they are to repay you. Also worth checking, a bond's duration, which tells you how sensitive it is to interest rate changes. Quick reminder, holding too much of a single stock or bond can increase your risk since you're relying heavily on just one company or issuer. And then there are ETFs and mutual funds. Look for funds with an objective that aligns with your goals. Maybe it's one that aims to track the performance of an index, like the S&P 500, or an entire sector, like tech. Whatever your objective, consider looking for funds that expose you to a diversified mix of investments. What's also important is performance against their benchmarks. Is it doing a good job mirroring the performance of what it's supposed to? When you invest in a fund, you usually pay an expense ratio, a percentage of the fund's assets used to help cover the costs of running it. These costs usually show up as a reduced return on the investment. Let me show you how it adds up. Let's say Michael and Erica each invest $10,000 in funds that deliver the same 10% annual return, except Michael's fund has a 1.5% expense ratio, while Erica's is only 0.5%. After 20 years, Michael's investment grows to about $51,000, but Erica's? Over $61,000. The truth is, you can find funds with expense ratios a lot lower than 0.5%. Some even have zero. While it can be helpful to reduce fees, remember, higher fees aren't always a bad thing when the investments are aligned to your goals.
And that's why I like to use Fidelity's screener tools when researching investments. It makes it simple to filter and find exactly what I'm looking for. Like when I'm looking for an ETF, I can easily choose the time period, analyst and rating, and expense ratio. You can save your searches and filters, which makes it easy to search for that again in the future. There's one more step: managing it. Your needs change as your life does. From time to time, you'll want to take another look at your strategy to make sure it's still the right plan for your goals, time frame, and risk appetite. Also, an essential part of managing your strategy is rebalancing your portfolio occasionally. Many experts believe investors should review and confirm their goals at least once a year. As you buy, sell, and hold investments, your asset allocation may drift from your original mix. History shows many investors who sold stocks during down markets underperformed compared to those who stuck to their strategy. Sometimes you just have to let it go to work. Now you know what can happen when you get a little strategic with building your strategy. Still have a question? Let us know in the comments. That's it for today. Till next time, investors.